For exclusive content that Shakaama offers, join us over at Patreon as supporter of the Shakaama Live Show. That's video content you won't see on YouTube that can help you grow and maintain your wealth, financial education wrapped up in plain English, and video series of interesting and thought-provoking topics. Join us at bit.ly/PatronShack. It's the first link in the information box. First, I'd like to thank you for supporting Shakaama directly here on Patreon. This is the official start to the stock investment series, but before I start investing and go full hog into it, some things have to be identified or defined. This is the preliminary education that must be had before getting into investing. I will, of course, educate you as we go along. This preliminary video will be made available on YouTube, but all the rest will be exclusive to the direct supporters on Patreon, since these financial videos have terrible viewership on YouTube. As such, you demanded that I keep doing these, but you also said you would be willing to directly support the videos. If you want to see the entire series and you're on YouTube, simply support the series directly on Patreon. The first link in the information box will take you there. For business inquiries, if you want to sponsor a video and you're seeing this video on YouTube, contact me on Facebook under Shakaama or Twitter under Shakaama. So this first video is made available on both Patreon and YouTube. All the rest will be exclusive to Patreon, patrons only. So to see all the rest, be sure to view them on Patreon. Let's get started. Before I talk about investing in dividend income generating portfolio, we have to understand a very integral term, and that is the PE ratio. Chances are you've heard the term price over earnings ratio, PE ratio, used before. When it comes to valuing stocks, the price per earnings ratio is one of the oldest and most frequently used metrics. Although a simple indicator to calculate, the PE ratio is actually quite difficult to interpret. It can be extremely informative in some situations, while at other times it is next to meaningless. As a result, investors often misuse this term and place more value on the PE ratio than is warranted. In this tutorial, we'll introduce you to the PE ratio and discuss how it can be used in security analysis and, perhaps more importantly, how it should not be used. What is the PE ratio? P/E is short for the ratio of a company's share price to its per share earnings. As the name implies, to calculate the P/E, you simply take the current stock price of a company and divide it by its earnings per share. So P/E ratio equals market value per share, earnings per share, or EPS. Most of the time the PE is calculated using EPS from the last 4 quarters. This is also known as a trailing PE. However, occasionally the EPS figure comes from estimated earnings expected over the next 4 quarters. This is known as the leading or projected PE. A third variation that is also sometimes seen uses the EPS of the past 2 quarters and estimate of the next 2 quarters. There isn't a huge difference between these variations, but it is important to realize that in the first calculation you are using actual historical data. The other 2 calculations are based on analyst estimates that are not always perfect or precise. Companies that aren't profitable and consequently have a negative EPS pose a challenge when it comes to calculating their PE. Opinions vary on how to deal with this. Some say there is a negative PE, others give a PE of 0, while most just say the PE doesn't exist. Historically, the average PE ratio in the market has been around 15 to 25. This fluctuates significantly depending on economic conditions. The PE can also vary widely between different companies and industries. Now that you understand what PE ratio means, let's see how we can use. Theoretically, a stock PE tells us how much an investor are willing to pay per dollar of earnings. For this reason, it is also called the multiple of a stock. In other words, a PE ratio of 20 suggests that investors in stocks are willing to pay $20 for every $1 of earnings that the company generates. However, this is far too simplistic way of viewing the PE because it fails to take into account the company's growth prospects. Growth of earnings. Although the EPS figure in the PE is usually based on earnings from the last 4 quarters, the PE is more than a measure of a company's past performance. It also takes into account market expectations for a company's growth. Remember, stock prices reflect what investors think a company will be worth. Future growth is already accounted for in the stock price. As a result, a better way of interpreting the PE ratio is a reflection of the market's optimism concerning a company's growth prospects. If a company has a PE ratio higher than the market or industry average, this means that the market is expecting big things over the next few months or years. A company with a high PE ratio will eventually have to live up to that high rating by substantially increasing its earnings, or the stock price will need to drop. A good example is Microsoft. Several years ago, when it was growing by leaps and bounds, and its PE ratio was over 100, today Microsoft is one of the largest companies in the world, so its revenues and earnings can't maintain the same growth as before. As a result, its PE has dropped to 43 by June 2002. This reduction in the PE ratio is a common occurrence as a high growth startups solidify their reputation and turn into blue chips. The PE ratio is a much better indicator of the value of a stock than the market price alone. For example, all things being equal, a $10 stock with a PE ratio of 75 is much more expensive than a $100 stock with a PE ratio of 20. That being said, there are limits to this form of analysis. You can't just compare the PE ratio of 2 different companies to determine which is better. Did you get that? Did you get that calculation? So it's a $10 stock with a PE ratio of 75 versus a $100 stock with a PE ratio of 20. It is difficult to determine whether a particular PE is high or low without taking into account 2 main factors. Number 1, company growth rates. Number 2, industry. Number 1, company growth rates. How fast has the company been growing in the past, and are these rates expected to increase, or at least continue in the future? Something isn't right if a company has only grown at 5% in the past and still has a stratospheric PE. If projected growth rates don't justify the PE, then a stock might be overpriced. In this situation, all you have to do is calculate the PE using projected EPS. Number 2, industry. It is only useful to compare companies if they are in the same industry. For example, utilities typically have low multiples because they are low growth, stable industries. In contrast, the technology industry is characterized by phenomenal growth rates and constant change. Comparing a tech company to a utility is useless. You should only compare high growth companies to others in the same industry or to the industry average. You can find PE ratios by industry on Yahoo Finance if you're so inclined. Now, to be the well-rounded investor that I know you're going to be, let's talk about some problems with PE. So far, we've learned that in the right circumstances, the PE ratio can help us determine whether a company is over or undervalued. But PE analysis is only valid in certain circumstances, and it has its pitfalls. Some factors that can undermine the usefulness of the PE ratio include inflation and accounting. Earnings is an accounting figure that includes non-cash items. Furthermore, the guidelines for determining earnings are governed by accounting rules, which I already talked about in another video, generally accepted accounting principles, GAAP. That was on my accounting video. that change over time are different in each country. To complicate matters, EPS can be twisted, prodded, and squeezed into various numbers depending on how you do the books. The result is that we often don't know whether we are comparing the same figures or apples to oranges. Inflation. In times of high inflation, inventory and depreciation costs tend to be understated because the replacement costs of goods and equipment rise with the general level of prices. Thus, PE ratios tend to be lower during times of high inflation because the market sees earnings as artificially distorted upwards. As with all ratios, it's more valuable to look at the PE over time in order to determine the trend. Inflation makes this difficult, as past information is less useful today. A low PE ratio does not necessarily mean that a company is undervalued. Rather, it could mean that the market believe the company is headed for trouble and fear in the near future. Stocks that go down usually do so for a reason. It may be that the company was warned that earnings will come in lower than expected. This wouldn't be reflected in a trailing PE ratio until earnings are actually released, during which time the company might look undervalued. Now, PE isn't everything, but I wanted you to understand what PE ratio meant first, because it is one of the ways that you analyze how good a company is doing. What goes up? Well, sometimes it stays up for an awfully long time. A common mistake among beginner investors is the short selling of stocks because they have a high PE ratio. If you aren't familiar with short selling, it is an investing technique by which an investor can make money when a shorted security falls in value. I short a lot. I prefer shorting to actually investing. I'm a negative person, I'm sorry. Short simply means instead of buying a stock, hoping it goes up, and then selling it when it goes up so that you make profit from it going up and your sell price. It's the exact opposite. You sell a stock that you're hoping is going to go down. That's how I made $10,000 in a couple of minutes, shorting gold ETFs. I'm sorry. But you sell a stock hoping it will go down, and then you cash out of the stock or buy it back when it's at a lower price. You see the difference? It's the exact opposite. Now, how are you selling stock that you don't own? You borrow somebody else's stock, basically. First of all, we believe that novice investors shouldn't be shorting. Secondly, you can get into a lot of trouble by valuing stocks using simple indicators such as a PE ratio. Although a high PE ratio could mean that a stock is overvalued. Now, before I continue, there is no guarantee that it will come back down anytime soon. On the flip side, even if a stock is undervalued, it could take years for the market to value it in the proper way. Security analysis require a great deal more than understanding a few ratios. While the PE ratio is one part of the puzzle, it's definitely not a crystal ball. And before I bring this video to a close, I am a technical investor. I'm a short-term day trading technical investor. That means I literally don't care about the company. I look at the actual chart. I learn everything that I can about a chart. And if you want to do that, that'll be a completely different series from the series that we're doing now. I am literally trying to do fundamental analysis. What is called fundamental analysis. This is what Warren Buffett does. He actually looks at the company. He looks at everything about the company. He looks at the industry. He looks at the market. He looks to see what the Federal Reserve is doing. He looks to see what Obama's doing. He looks to see if there is any international conflict that could impact the company. He looks at the economy to see if people are able to buy into the company. He looks at the sales of the history of the company, who's managing the company. I did the exact opposite. I looked at the chart and looked at the chart, the historical aspects of the chart. Is there volume? Is there support? That's a completely different video. It's a completely different way of investing. And more than likely, it's not investing at all. As far as fundamental people are concerned, it's not investing at all. It's a trick of gaming the system. But why not game the system when the system is there, right? So if you want me to do that video talking about technical analysis and how to be a day trader, you can indicate that in the comments below, either on YouTube or Patreon. So let's conclude this video here. What we have learned about the PE ratio. Although the PE ratio often doesn't tell us much, it can be useful to compare the PE of one company to another in the same industry, to the market in general, or to the company's own historical PE ratios. Point by point, the PE ratio is the current stock price of a company's dividend by its earnings per share, EPS. Variations exist using trailing EPS, forward EPS, or an average of the two. Historically, the average PE ratio in the market has been around 15 to 25. Theoretically, a stock PE tells us how much investors are willing to pay per dollar of earnings. A better interpretation of the PE ratio is to see it as a reflection of the market's optimism concerning a firm's growth prospects. The PE ratio is a much better indicator of a stock's value than the market price alone. In general, it's difficult to say whether a particular PE is high or low without taking into account growth rates and the industry. Changes in accounting rules as well as different EPS calculations can make analysis difficult. PE ratios are generally lower during times of high inflation. There are many explanations as to why a company has a low PE ratio. Don't base any buy or sell decision on the multiple alone. Now, in the very next video, we're going to take a look at about 20 companies and look at their PE ratios, just so I can hone in on what PE ratio actually means. We'll do the calculations. It'll be really simple, straightforward. I'm just going to show you the PE ratio so you can see. And then I'll have several companies in the same industry. So then we can determine, is this a high PE ratio or is this a low PE ratio? Okay. Thank you for watching the Shakaama live show. For exclusive content that Shakaama offers, join us over at Patreon as supporter of the Shakaama live show. That's video content you won't see on YouTube that can help you grow and maintain your wealth, financial education wrapped up in plain English, and video series of interesting and thought-provoking topics. Join us at bit.ly/patroncheck. It's the first link in the information box.